Picture this. The CEO of the hottest tech company on the planet just said his $200 monthly plan loses money on every single customer.
Not a little bit, not break even while they grow. Actually loses money.
And what did Wall Street do? They valued his company at $500 billion.
Anyway, I'm Alex. Welcome to the AI bubble, where we jumped from neat chatbot to $7 trillion bet in just 24 months.
And why the big money players might be headed for the worst shock since 2008.
November 30th, 2022. Just a normal Wednesday. Morning coffee brewing. Coders fixing stuff. Then OpenAI released ChatGPT. In 48 hours, the internet went crazy.
People started using it to write apology texts, fix their code, understand space stuff, and create superhero stories.
Dad, I'm talking to an AI that knows everything. It just explained quantum entanglement using Minecraft terms. 2 months later, 100 million users. Fastest growing app in history. Instagram took 2.5 years to hit 100 million. Facebook took 4.5 years. ChatGPT did it in 60 days, and Silicon Valley absolute panic.
Inside Google's headquarters, executives were losing their minds.
Google CEO said, "We invented this technology. The transformer model, that was us. The research paper has our names on it. Then why is my son using ChatGPT and not Google AI? Because we were too afraid to launch it. Fine, launch something now. Call it Bard, Gemini, whatever. Ship it." Google scrambled. They had the tech. They'd had it for years, but they were terrified of what it might say.
Of lawsuits, of bad press.
OpenAI had no such fears. They shipped first. And in tech, first mover advantage is everything.
Within weeks, Microsoft dropped $10 billion into OpenAI, with another $3 billion ready to go. Google Panic launched Bard, and it immediately made things up during its first demo.
Amazon started dumping billions into Anthropic.
We're a dog walking app, but the route optimization uses machine learning. Say no more. Here's $50 million. Don't you want to see our demo? Shut up and take my money! By mid-2023, if your slide deck mentioned neural networks or large language models, you were basically printing money. Startups with no revenue, no real product, just a small team and a shared Google Doc were raising $100 million rounds. The bubble gave us wild inventions, like AI toothbrushes, AI meal planners, even AI dating coaches. One company raised $30 million just to build an AI that summarizes other AIs.
We'd reached peak absurdity.
But the real insanity, the GPU shortage. These little computer chips, which look like harmless circuit boards, became more valuable than gold or oil. NVIDIA became one of the most valuable companies on Earth. Their CEO, Jensen Huang, showed up at events in leather jackets like he was the rock star of semiconductors, and honestly, he kinda was.
Renting one high-end H100 GPU costs about $3 an hour.
Sounds cheap, right? But startups don't need one. They need hundreds. A small startup training a single model might rent a cluster of 500 chips. That's $1,500 every hour, $36,000 every day, over $1.1 million each month just for renting GPUs. Yet, companies were still hoarding GPUs like doomsday preppers stockpile canned beans. NVIDIA couldn't manufacture them fast enough. The wait list was at one point up to 12 months long. Black markets emerged. Seriously, people were smuggling GPUs across borders. By 2024, everything was AI-powered. Your toaster burns bread with 10% more efficiency. Your grocery store self-checkout. Just a camera, but now it's machine learning.
The party was booming, champagne flowing, checks clearing. How much does this actually cost?
Sam Altman, CEO of OpenAI, the face of the AI boom, tweeted something that made investors panic. People use it way more than we thought. Yep, you heard it right.
OpenAI charges $200 per month for their Pro tier, and they lose money on every single subscriber. Which means the more successful they are, the more money they lose. At this rate. When they launched ChatGPT Plus at $20 a month, the whole pricing plan was basically a test. Try $20, try $42, see which one people complain about less, and stick with that. No deep research, no cost breakdown, just vibes. That's how a $500 billion company set the price for its main product. But it gets worse. OpenAI's 2024 numbers. Revenue $3.7 billion, losses $5 billion.
They didn't just miss profit. They lost way more than they made.
Now here's where it gets truly insane. Industry forecasts show AI infrastructure will require $6.7 trillion by 2030.
Let me break that down.
$5.2 trillion directly for AI infrastructure, GPUs, accelerators, power upgrades, cooling, and data center construction.
While the remaining $1.5 trillion goes to traditional, non-AI cloud infrastructure.
The 4 largest tech companies alone are expected to spend $350 billion in 2025.
And here's the kicker. To justify these costs, the AI industry needs to generate $2 trillion in annual revenue by 2030.
Current total AI revenues? Somewhere around $200 billion. That's a 10 times gap, Sam. Our projections show us at $20 billion in 2025.
You're proposing we hit $100 billion by 2029. It's the necessary growth trajectory. That's not a growth plan, Sam. That's a hockey stick drawn by someone who's never touched a hockey stick. Do you know what it costs to even try this? $115 billion burned by 2029.
When do we actually make money? 2029? Maybe 2030 or 2031?
And if revenue doesn't hit $100 billion, if that hockey stick of yours breaks, then we raise more cash. From who? Who's left? Microsoft? Saudi Arabia? Some overly hopeful pension fund? Plenty of fish in the sea, right?
Since 2021, private investors have pumped hundreds of billions into AI startups.
Most of that went to just 10 companies whose combined valuations swelled by nearly $1 trillion.
Everyone's betting they'll become the next Google. Then the failures started rolling in.
ChatGPT hallucinated. Tech speak for completely making things up and cited.
Research papers that don't exist, legal cases that never happened, and statistics from an alternate dimension. Google's AI told users to put glue on pizza to make cheese stick better.
It learned this from a Reddit joke. Yes, really.
The lawsuits arrived next. Artists, writers, musicians, journalists, all asking the same question.
Did you train your AI on my copyrighted work? Answer. The New York Times sued OpenAI. Jetty Images sued Stability AI. Authors sued everyone. Musicians sued everyone else.
We didn't steal. We learned from publicly available data.
You scraped the entire internet without permission and used it commercially.
By mid-2024, the cracks were showing. The vibe shifted from euphoria to something more dangerous. Doubt.
The hype was loud. The math was ugly.
Now everyone had the same uncomfortable question buzzing in their heads like a mosquito at 3 a.m.
So when does this whole thing explode? This looks like a bubble. The losses are insane. The valuations are delusional.
This bubble isn't popping the same way the dot-com bubble did.
Why? Because the people inflating it
are also the people with the biggest wallets on Earth.
Unlike 1999, when startups had 0 revenue and 17 foosball tables.
Today's AI bubble is being funded by big tech companies that actually make money.
Real money! Buy an entire country if we feel bored money! Microsoft prints billions from Azure. Google prints billions from ads. Meta prints billions from showing you memes your cousin already sent on WhatsApp.
These giants aren't investing in AI because it's profitable. They're investing because they're terrified of being the ones who didn't. If AI becomes the next iPhone moment, the next Google moment, the next entire world changes overnight moment, then the company that slowed down becomes BlackBerry. And nobody wants to be BlackBerry. Think of big tech like poker players who all brought unlimited chips. If Microsoft folds, Google wins. If Google folds, Amazon wins. If Amazon folds, Meta wins. No one blinks, no one folds, everyone keeps raising the stakes.
And that brings us to the real uncomfortable question. If everyone keeps spending, how do bubbles ever pop?
Short answer is they burst when a real-world event forces everyone to stop pretending.
And historically, that event usually comes in 3 forms.
1. The money suddenly disappears.
The dot-com bubble didn't collapse because websites were dumb. It collapsed because the cash spigot shut off. Interest rates rose, borrowing got expensive, funding vanished, and thousands of companies evaporated overnight. If interest rates rise anytime soon and big techs tighten their budgets, the AI bubble ends instantly.
2. A big, embarrassing meltdown happens. Every bubble has a moment.
One spectacular failure that freaks everyone out. Dot-com had earnings disasters.
2008 had Lehman. Crypto had FTX. AI's version could be a big lab showing huge losses.
And a failed model launch or a lawsuit that stops everything.
So, where are we right now? Big tech is still spending. No meltdown earnings call yet. No FTX-level scandal. Things look shaky, but not enough to break confidence.
Yes, this bubble is inflated. Yes, the numbers are crazy. But it won't pop just from hype. It pops when one of the giants finally says, "That's enough!"
Until then, the bubble floats. We're not at the explosion.
If this breakdown made sense to you, hit like, subscribe, and share. It helps a lot.